So I think a narrative that we're seeing is that, during the whole kind of quote unquote Web3 thing that was happening, basically everything had a token associated with it. And basically that was just kind of like a lot of projects trying to get paid up front, whether or not the underlying project ends up delivering anything durable. Basically facts. That's the way ability to try to just have everybody do seniorage. And what we're kind of seeing lately is the idea that a decentralized web is a good thing. It's just that you don't need your own token attached to it. So we've seen, I mean, you mentioned Noster. There's also the whole Keat slash tags, that vector.
Yes.
There's Web5, right? There's multiple different kind of angles here. And we'll see how some of them fit together or compete with each other over time. But the point is, it's just basically showing that when there's actually a good product market fit, the product sells itself. You don't need to like add unnecessary gambling to it, try to get out of the position quicker. You're actually building something of value. And then the fact that there's this common money associated with it also allows for monetization in the normal way. Kind of like if you invent like Uber app, you don't have to invent like another one with its own money. Right. Dollars are fine, or obviously, Lightning would be great, but like basically you don't need to like reinvent money every time you reinvent like a new service. And I think we're seeing that play out in the kind of the Bitcoin focused, kind of decentralized web applications that have been gaining some momentum lately. So tying back to my earlier comments about developing countries having their debt denominated in their own currency, last time we saw the developed world go through like a period that's like now where you have like over 100% debt to GDP was like the 1940s. And you had very high debt levels. And what a lot of them did was various types of financial repression, which includes yield curve control. So, for example, the United States did the Federal Reserve did yield curve control, where they say, okay, we're not going to let, yeah, in addition to controlling the short end of the curve, we're also going to not let the long end of the treasury curve go over a certain amount. And for the United States, that was 2.5%. So inflation averaged something like 6% from the early 40s to the early 50s. It spiked as high as 19%, but they held short-term rates near zero. They held the long end at 2.5%. And the way they do that is they say, we're willing to print money and buy any bond that trades over that yield. Or putting it another way, because bond prices are inverse to yield, any bond that tries to go below a certain price, we're going to buy. And essentially what they try to do is train the private sector to do it for them, because private sector comes to know if they start to view that as credible, like let's say the yield goes to 2.6%, JP Morgan could come and buy that, knowing that if it stays above 2.5% for any length of time, they'll be able to sell it to the Fed, and they'll be able to make this basically risk-free profit, assuming the Fed actually, sticks by their yield curve control target. And of course, that ends up inflating away a significant part of the debt because you hold the yields below the inflation rate with basically a limited QE as needed to do it. And so fast forward to the modern time, it's this is the first time since then where we see a lot of developed countries with well over 100% debt to GDP, and Japan's is the highest at over 200% debt to GDP. So they have a very, very large sovereign debt load, and they can't afford significant interest rates on their debt. And they also want to maintain very easy monetary conditions, despite the fact that inflation is above their target. And so they've been doing for a while, they were holding their yields at 0.25%. So the 10-year yield was at 0.25%, even though the rest of the world was hiking their interest rates, even though Japan's inflation was above their official target, they were still holding that really low. And they had to buy quite a lot of bonds in order to hold that at that level. A little while ago, I forget how long ago it was now, time flies so quickly, but they kind of overnight, they expanded that to 0.5%. So they basically let the yields go a little bit higher to 0.5%, which is still below the prevailing inflation rate, below the inflation rate target. And so it's kind of, first of all, it's relevant on a global scale because it's kind of like a canary in the coal mine. We're seeing how some of these very indebted countries can handle this, basically see how hard is it to do, what are the pitfalls that central banks might run into when trying to implement this policy. It certainly wasn't easy in the 40s, and it's not been easy for Japan here in the 2020s. But it's also relevant at global scale for other reasons. One is that, aside from being very indebted, Japan has a very positive net international investment position, meaning that they had decades of current account surpluses, and they use those current account surpluses to go and buy foreign assets. So they own, $1 trillion worth of treasuries, the biggest treasury holder, external to the United States. They go out and buy US stocks. They go out and buy European stocks. They go out and buy commodity deposits and things like that around the world. they own a lot more foreign assets than foreigners own of Japanese assets. And basically when they start to run into a currency crisis, one thing they can do, in addition to manipulating yields and things like that, they can also sell off some of those foreign assets, especially ones that are owned by the central bank, owned by official accounts. And so and then a third thing is that because their rates are so low, a lot of foreign entities have used them as a funding source to then go out and buy foreign assets. And so often what you'll see is that, when US interest rates are also pretty low, you'll see that a lot of Japanese investors will go buy treasuries and then they'll hedge them back and, to take out the dollar risk compared to the yen, and they'll still get a better yield than they can get on their local currency. But lately, because the US interest rate has increased so much, if a Japanese investor wants to buy US treasuries and they want to hedge out the currency risk, that's actually a lower FX hedge yield than what they can get in Japan. And so basically, this can kind of ripple through the rest of the global bond market. Part of why they've been able to stay so low is because Japanese yields have been so low. And so this is kind of like a real-time experiment, for the first time in many, many decades, to see a very, very large developed country try to artificially suppress like, essentially its entire yield curve below the prevailing inflation rate and all the pitfalls that come with that. I think around the margins, that's been a contributor. Generally, one thing you see historically is that when the dollar is going up very rapidly, because there's so much dollar denominated debt out there,
Mhm.
you'll see a lot of entities sell treasuries or other dollar denominated assets to get dollars to then service their debts. And one thing people forget is that, a lot of people mention this $13 trillion debt figure, but they forget to mention that there's over like $50 trillion worth of US assets held by the foreign sector. And so they have way more assets in aggregate than they have liabilities. And obviously that depends on the jurisdiction. So for example, Turkey has more liabilities than assets. So they're more stuck. Whereas an entity like Japan has way more assets than liabilities when it comes to the foreign dollar denominated variety. And so if you're trying, basically the hard part about yield curve control is that if you're trying to manage your yields artificially, the release valve is the currency. So if you hold the yield artificially low, you're going to get your currency weaken more than it otherwise would. But then the third variable they can do, if only if they have a lot of reserves, is they can also then sell some reserves. And so instead of weakening the currency, they can lower their reserve balance. But then that can damage the asset that they're selling, which in this case might be treasuries. The US like dollar peak coincided with a bottoming in domestic liquidity. So the market started to price in slower rate hikes from the Fed, which has so far been somewhat materializing. And then also the Treasury general account has drawn down. That gets pretty jargony, but essentially that the Treasury's kind of been partially offsetting some of the QT that the Fed's been doing, possibly in partly in response to this upcoming debt ceiling issue. And so at least temporarily, there's slightly improved domestic liquidity. And then the weaker dollar is giving that global liquidity a little bit of a boost. And so I wouldn't say that all of that's due to Japan, but certainly Japanese selling of treasuries is easily a potential variable to that because anytime that a large amount of foreign assets get sold from the US, that can cause problems. We've also seen, for example, Switzerland, a lot of these other ones will just stop buying some US equities and stop buying some US assets that they were just endlessly piling into, which is now somewhat reversing. Basically, I think the move got overdone to the upside.